Yeah, the topic of today's talk is futures. That's a bit theoretical. I don't know, has anyone some background in futures already, traded futures once, knows a lot about it? Yeah? Okay. Okay, cool. And I don't know how much will be new today. Feel free to interrupt me anytime with questions if you have questions. Can this be read in the back? Is it good? Okay, cool. Okay, so let's maybe start with what is a future. A future is a financial instrument. It's a derivative. Technically, it's a contract between two parties. They agree today on a delivery in the future. That's the name futures. So futures are exchange-traded derivatives. We can make an agreement to deliver anything in the future. This is okay. This would be a forward. So the difference between that forward and the future is that a future is exchange-traded and a future is standardized. So we will get to standardization in a moment. A future contract always has two sides, the buyer and the seller. The buyer is said to be long. He receives the delivery of the good, and the seller is short. He makes the delivery of the good. Futures contracts can be created by just an agreement of two individuals or two companies, whoever participates in the market, to make that delivery at a certain specific date in the future, and can be extinguished by an offsetting transaction. So if I am long in, let's say, the wheat future with one contract, I can offset that position by just selling my long or buying a short. That's basically the same thing. Okay, futures can be settled by either physical delivery or cash. The purpose of futures usually is that you, as producer, that's how it originated, that you as producer can lock in price for a commodity for a later point. So let's assume you are a farmer and the crop year starts. You haven't even started planting yet, but you already want to know how much you get for the crops in autumn and fall when you sell them. So that's the purpose of futures. You can buy a short contract and lock in a price today for the wheat that you have not even planted yet. And on the other side, of course, there would be a company and an industry looking for wheat in fall and would like to buy the wheat from you. And it's an advantage for them as well if they know today already what they need to pay you in fall to get the delivery. So that's how futures originated. The big advantage of futures is that they are standardized. So both parties of the futures contract agreement know what they get. Let's talk a little about that standardization. It's, of course, the first and most important thing is the definition of the underlying. If you buy a future, you know what kind of future you buy. So a future for gold would be physical gold. A future for wheat would be wheat, and so on. So the definition of the underlying is one thing that determines a future. The second thing is the contract size. So it's also specified every future for, say, West Texas Intermediate crude oil on the CME has the same contract size, 1,000 barrels. This is also something that is standardized. Then, of course, the settlement mechanics. So if I buy oil, where do I get it? When do I get it? Is this future about a physical delivery? So would I need to drive to Chicago and grab my 1,000 barrels of oil? Or are they cash settled? So do I just get the difference between the spot price and the price at which I bought the future in cash? Then the delivery or maturity dates. Not all futures have contracts for all months. For example, crude oil has a contract for every month. But some bonds and stock indices like the S&P only have quarterly delivery contracts. So yeah, that's also individual with all futures contracts. And then, of course, the grade or the quality of the underlying. So I mentioned already, crude oil comes in different grades and qualities. Brent is different from the West Texas Intermediate crude oil. So this is also specified in the futures contract, and thus it's standardized. So both parties know what they have either to deliver or what they get. Okay, what markets can become futures markets, or what is the requisite of a future market? The most important thing is that it needs to have an underlying spot market. So there needs to be a market for a real physical commodity, for something that a lot of people need. And the producers need to manage risk with it. So that's again how futures originated. Agricultural commodities, farmers needed to manage the risk, wanted to lock in prices, and that's how the first futures appeared in Chicago, by the way. Yeah, active underlying market, and of course the existence of an efficient delivery structure. So for not cash settled futures, so for futures with physical delivery, you want to know where you get it in the end, where you get the future. And then there is, of course, a fourth thing, government policy. So not all environments, legislative environments, favor futures. For example, if the prices are controlled by the government, it makes no sense to have a future, because you know that the government will define the price of the underlying commodity, either cap it at a certain point or just define it. So an example of that would be here in the US during World War II. Certain goods had a fixed price, the government regulated price, so there was no need for future markets. Okay, a little more about the origin of futures. I mentioned already they came from agricultural commodities, and actually the Chicago Board of Trade was the first exchange that standardized forward contracts into futures. This was about 1864, and it was based on grain trading. As you can see here in these pie charts, until 1970 actually, most of the volume that was traded with futures were agricultural commodities, and only in the last 40-something years this shifted heavily towards financial instruments. So futures were really a long time used for agricultural commodities. Yeah, futures are attractive markets to trade for many people, many participants. They are among the most liquid markets worldwide. So the only markets that are as liquid as futures are the foreign exchange markets between the G10 or so. So futures are really among the most liquid markets worldwide. Liquidity is always good, because that means that if you want to buy something, you find a seller, and if you want to sell something, you find a buyer. So liquidity is a huge plus for markets. Then they are regulated and standardized. This is also an advantage. You know what you get. There is a low risk of counterparty default, because the clearinghouse, this is an entity in futures trading, substitutes itself for the counterparty risk. So you would not trade with a specific trader, make the exchange for the future, but the clearinghouse substitutes itself. So there is a very low counterparty default risk. And of course, the biggest advantage also for us, and one of the reasons why we focus on futures, is they come with a huge, diverse universe of underlying markets that are not correlated. So the price of, say, wheat or crude oil is usually not very related to the Japanese yen or to the S&P 500. So uncorrelated markets, very liquid markets. And of course, yeah, the last upside is for hedgers, that they can use futures to reduce unwanted business risks. So maybe an airline wants to hedge themselves against a rise in kerosene prices, because they expect that kerosene will become much more expensive in the next year. They could just buy a long contract for kerosene and lock in today's prices for the next year. So those would be hedgers. Yeah, the mechanics of trading futures. If a futures contract is opened, then both parties make a down payment, so to say, a guarantee deposit at the exchange clearinghouse or broker. And this is usually between 5 and 15% of the notional contract value. This is called the initial margin. So you deposit at your broker a few $1,000, to buy a contract that can be worth up to $100,000. So the full price is only paid upon physical delivery of the commodity at the expiration of the future and not right away. So if, let's say, Novi and I agree on a delivery of wheat in March 2016 and the notional value of the contract would be 25K, this would take a down payment of 2,500K and 2,500K from you and from me, and the future contract would be created, would exist. Of course, one of us would be obligated to pay the full price when the physical delivery happens, if the futures contract still exists by then. Yeah, so this is a huge upside of futures, especially for trading, because it can maintain a large position with little capital, which results in leverage. So you can buy things on margin and use leverage. Yeah, offsetting of a future is made, I mentioned that already initially, if you just buy the other side. So if I hold a long contract, I just buy a short contract. And the future is offset, or I sell the long position. This is basically the same thing. Okay, let's do a little example of margin and leverage. I go along one 10-year note, government bonds. The contract value of this guy would be 130K. And I can do that with a margin deposit of, say, 13K, depending on the contract that I have with my broker. And this gives me a leverage of 1 to 10. So leverage, of course, comes with both up and downside. If I deposit this only 13K, I'm still exposed to the risk of a 130K position. That's leverage, basically. So if the 10-year, the price of the 10-year note falls by 6.5K, which is a 5% move against us, measured in notional contract value, we have already suffered a loss of 50% of our initial margin. So if you have manage your risk, manage the leverage. This is very, very important. If you want to trade 100K and invest it in the 10-year note, it's not very smart to buy, I don't know, 7 10-year notes, because you could do that theoretically. Your broker will allow you to do that because you have the margin for it. But then you would be exposed to 7 times the risk of one 10-year note. Okay. Yeah, so what happens if that happens in reality? So if our margin deposit is not sufficient, so if the position moves against us, there is a so-called maintenance margin. And as soon as we are below that border, so let's assume the maintenance margin for this guy is not 13K but 10K. So if the position moves against us more than $3,000, we would get a margin call from our broker and would be asked to deposit additional funds in order to maintain the position. If we fail to do that, then the position would be closed out by the broker. And the bad thing is about that, of course, that the losses are not limited to the margin deposit. Because keep in mind, you're trading a future that is worth 130K. If for whatever reason you cannot close out the position in time and your loss is higher than the initial margin deposit, you still owe the money to the broker. So if the position goes against you 20%, and is not closed out for whatever reason, then your losses are 26K and not the 13K that you deposited as a margin. Okay, so yeah, that's the risk about leverage. Leverage can work both ways, of course, so both up and down. But that's actually one of the advantages of futures, one of the huge advantages, because institutional investors can adjust the risk that they want to be exposed to. So if they have $1 million under management, and the trading strategy, one of your trading strategies may be that has a yearly volatility of only 5%, which is per se not a lot, they can trade the same trading system with a volatility of 20%, because they simply can use leverage to leverage up the positions. So that's why quants can really focus on optimizing the Sharpe ratio, which is the performance to volatility ratio, rather than the overall pure performance of their strategy. Because the investor is the one who decides with what kind of volatility they want to trade your strategy. Okay. Any questions to margin and leverage? Everything clear? Okay, cool. Yeah, this is an example of the properties of the future. I hope it can be read. The first thing is, of course, the underlying, so what the future is about. In our example here, it would be a Quant future. Then, of course, the unit of one future contract. This is also standardized for a commodity. In the case of corn, this is just 1 bushel. And the contract size. A future corn future always consists of 5,000 bushels. Not more, not less, always 5,000. And the price quotation, in this case, cents per bushel. And what is the settlement? Physical delivery. And then there are the contract months. Not every future has a contract in every month. So in this case, this is an agricultural commodity. This would represent in some way, don't ask me how, but in some way this represents the crop cycle. Yeah. Usually there is a December contract, so this is something that you can rely on. Then there are 2 important days, which is the last trading day and the first notice day. The last trading day is the day when the future approaches its expiration, the last day when you can buy or sell that future on the exchange. And the first notice day is the first day where a short can announce he wants to make a delivery. So this happens during some days, not necessarily. Every short wants to deliver on the same day. So they might have a week or 2 weeks where they can announce delivery. But if your counterparty, your short, announces delivery, you have to take it. That's the point. So if you want to trade futures only for speculation and not for hedging, so not for really trading the physical commodity, you need to roll out of the contract you're in before it reaches either the last trading day or the first notice day. This is the absolute latest point where you should be out of the contract. This brings us to the process of rolling. The so-called roll is when I need to get out of a position, or when I want to get out of a position, because the contract expires at some point, but I still want to be invested in the underlying commodity. So what I would do in this case is I just sell the so-called front contract. The front contract is the contract with the closest expiration date, and I buy the back contract. So usually it is the first back contract because the contracts that are closest to their expiration are usually the most liquid contracts. So there is no steady course for futures like there is for stocks. If you buy a stock, you have a portion of the company. There is a steady course every day. It goes either up or down, and as long as you hold it and the company does not go bankrupt, you will have a dollar value for every day. This is not the case for futures. Futures expire at some day. So if I'm invested in the March 2016 crude oil contract, it doesn't exist anymore in April. So all the contracts, March contracts are settled with a physical delivery in March. So if you want to have a continuous course of futures, you need to roll into the next contract. We go to the mechanics of rolling, come to the mechanics of rolling a little later. Right here. So let's assume I hold a 10-year note for 2015 December, but I want to be invested until February 2016, or at least longer until December. So what do I need to do? I need to sell my 2015 December 10-year note and buy instead, let's say, a March 2016 10-year note. So this would be a simple example of a roll.
When you do that, do you scale out profits at that transition point, or is everything just rolled?
The roll itself cannot produce a profit or a loss for you. The prices of the contracts at the same point do not necessarily need to be the same. This is what we discussed here with Contango or backwardation. But a roll usually just costs you money because you need to pay slippage twice, or you pay slippage twice. You need to pay your broker for selling the contract, you need to pay the broker for buying the contract, and in both cases you probably are not going to get it to your desired or ideal price because you most likely have to cross the spread of the order book at least. So rolling costs, but it's not awful, so not a So yeah, markets can either be in contango or backwardation. This is also a future term. Because contracts with the same underlying but different maturities do not necessarily cost the same. Contango is a situation where the future price of a commodity is higher for future delivery, for delivery later, and backwardation is just the opposite. So why is that? Because of, let's break it down to something simple, storage costs. It is simply, you have costs if you store crude oil from March until June. That's basically it. And these storage costs, you can see these storage costs in the price of a commodity. So contango is said to be the natural behavior of a future, at least of a future with physical underlying, so a non-financial future. And backwardation is the little awkward situation when you can buy something in the future cheaper than you can buy it right now. So this would be backwardation. This of course can also happen also with agricultural commodities. So let's assume there is a shortage on the market, but I'm a producer of, I don't know, cereals, breakfast cereals, and I need to buy corn right now. But there is a shortage in the market, so it could happen that I need to pay a higher price than if I wait 3 more months for a new delivery when the crop year is finished. So this would be an example of backwardation. Yeah.
Shouldn't storage costs be already priced into the expected future spot price? Because that's pretty constant.
Yeah, it's constant over time, but usually there is a time premium. That's when contango happens. So there is a time premium for just storing. But you're right. Of course, assumption of future price development also plays a role in whether the future is in contango or backwardation. You can see that especially on currency futures, interest parity theory, something like that. If a currency is expected to depreciate with respect to another currency, you can also see that in the future. Okay, these would be examples of such forward price curves. This is the price, this is the time, and this would be the forward curve. Unfortunately, the label is not very readable. The blue curve would be the price curve for a future in contango, and this would be a price curve for a future in backwardation. Okay, and here's a little table. We will publish the presentation afterwards, and you can look at it. This is taken from the CME website. An example, you can just look at the different contract maturities, in this case for crude oil. And as you can see, crude oil is in contango. So this guy would, making up numbers, this is the closest delivery month. Let's say this is the December contract, would cost 45 bucks, then in January 46, and in February 47, and so on. So you can see that the different maturities of futures have different prices, and prices rise usually the further ahead the physical delivery of the good is. Yeah, then the next very nice property of futures, I mentioned it already, is liquidity. So your orders are filled in no time, most of the time. And this liquidity of a future contract can be measured by 2 variables. The first variable is volume. We know that from stocks. This is just the same thing, so the number of traded contracts in a particular time. And the second thing, and this is a futures special, is the open interest. And the open interest refers to the total number of outstanding contracts, of unsettled futures contracts. So if Dirk and I agree on a delivery of crude oil, we create 1 contract. Open interest would be 1. And the difference to volume is Dirk could sell his contract to Nobi. This would create volume of 1, but it would not increase the open interest because there is still only 1 contract left. So this is the difference between volume and open interest. Usually in the industry, futures are said to be most liquid, and these are the ones that we want to trade. the contracts are the most liquid where the open interest is the highest, because this means that there are the most outstanding contracts, and yeah, this is what most traders, hedgers, speculators hold in their portfolio. Those contracts where the open interest is the highest. We always want to be exposed or have our exposure in the contract with the highest open interest, because this yeah, is usually the most liquid one. So that's how we measure liquidity. Usually it's the front contract, but there are cases where not the front contract, but one of the back contracts is the most liquid one. We, in production and in the backtesting toolbox, we will talk about that a little later, we roll the futures with an open interest switch. That means at that point where the front contract reaches or gets close to its expiration, we roll in the first back contract. So if you, let me illustrate this. Let's assume we have this guy open interest of the front contract, and at some point, first back contract, because let's say this is first notice or last trading day, whatever. So people who still have a position in that market at this point would get physical delivery. So these are the real hedgers, the guys who really want to get crude oil delivered. And at some point, the first back contract that has the same open interest profile becomes more liquid than the front contract, because this back contract has its first notice last trading day 1 month later. So at this point here, where the open interests of the both contracts cross, we roll into the first back contract. So this is how it's done in production, because this way we are always in the most liquid contract as measured by open interest, which would be this. Yeah. Who participates in futures markets? So there are two big groups of participants. The first ones are the hedgers. I already mentioned, for example, an airline, they want to hedge themselves against kerosene or crude oil prices, whatever. Or a farmer who wants to lock in the price for a future delivery of a grain. And the second participant would be speculators, guys like us. We deal with risk, so speculators who are willing to buy the risk of the hedger and trade with the risk of the hedger, because they think they can manage the risk better than the hedger can. So this is not a bad function of the market, so to say. Actually, speculators are very important in the markets. The markets would not function without speculators, simply because they provide liquidity. They're willing to buy whenever the farmer wants to sell. Okay. Yeah, and this brings us already to our toolbox and futures data. Yeah, like Dirk already said initially, we want to empower you guys to write quantitative trading strategies with futures or with stocks. Yeah, use them for yourself if you want. Our toolbox is free, it's open source, so is our data, it's also free. But if you want to market them to investors, if you want to get an investment in your strategy and make money as a money manager with no downside risk, then you can upload it to our platform and we market it to investors, and you get to pocket half of the performance fees that we charge them. This is an overview of the futures data that we have. At the moment we have, yeah, question? Okay, sorry. At the moment we focus on US futures. The CME, the Chicago Mercantile Exchange, is the most important futures exchange in the world. And so are the US futures, so they are the most important instruments. As you can see, futures, we have a lot of agricultural futures, from soybean oil to coffee, lumber, soybean meal, sugar, to wheat. They are usually not very correlated, and this is a nice property. They are usually not very correlated to what the so-called market, which is for most people just the S&P 500, so they're not correlated to what the market does. Then we have a couple of bonds, government bonds, treasury notes, basically with different maturities, durations from 2 to 30 years. Then a couple of currency futures, energies, crude oil, heating oil, natural gas, and so on. And then, of course, the financial futures. So these are among the most liquid markets, especially the S&P 500 index future is very liquid. Then, the Russell 2000, Dow Jones, NASDAQ, and so on. Then we have one interest rate, the euro dollars, and a couple of metals and precious metals. So this collection is a pretty good collection of the most liquid and most important US futures. It's of course not complete, but so there are others that we want to add to that list. But this is a pretty good snapshot already. We have the data back until 1990, at least for those contracts that existed back then already. So not every contract was already created in 1990. Okay.